clock is about to strike.
Andrew, we've already traded under yesterday's low yields in 10s. Right off the bat, that sets the table. Now, this number's expected to be weak because Michigan was weak. Many expect that the Delta variant is going to impact the U.S. psyche of retail shoppers, and we're expecting a number down about 0.3. Now, it's taking a while, which probably means it's better than expected, but that's just me thinking out loud. The dollar index, of course, really counterintuitive with some of its recent strength, considering what rates have done. Still don't see the data. And, of course, we want to pay particularly close attention to autos, because we know that autos have had a very special set of issues that have impacted supply chains and chip issues. So many are expecting that autos already deteriorated. So autos is probably what the most important number is. Most are citing big data is showing a big slowdown, but that's a split decision as well. Some of the MasterCard trackers show that in line with about 10 to 11% if you look at online and in-store sales. Of course, that excludes gas. I don't see this number popping up anywhere yet, Andrew, on any of the wire services. We do think that the control number, which is plugged into bigger data up the data food chain, so to speak, will also be negative. So 2 out of 3 expected to have a minus sign. And here it comes. And, well, looks like they were correct, minus 1.1%. And that really was the whisper number of many. So this is really the first retail sales number where the delta impact is maybe most obvious, just like the big drop in Michigan. Still don't see autos, gas, or the sales group number. What are yields doing with that first kind of shocking minus 1.1? Now, that is, it's not the weakest we've seen. We had minus 1.7 in May. But the point is we really want to see how much impact there is. All right, the control number is out, and that's a biggie. Down 1%. We were expecting 1/5 of that. Down 1% is pretty large until you look at the recent trends, of course. The recent trend was up 1.1 prior to that, just like in the headline number, we're minus 1.4. I'm going to kick it back to you. Yields have moved up a bit, which really goes to show that much of this weakness was expected. Still don't see autos or gas, Andrew.
Okay, we're going to keep our eyes on that. Thank you, Rick. I want to get straight over to Steve Leisman, who joins us with more as well. What are you thinking, Steve?
I just want to give you the data here. Autos down 0.4%. That's quite a bit worse than the 0.2% gain that was expected. Gas was down 1.4%. What I'm seeing here is a big drop in motor vehicle sales, 3.9%. And that seems to be as much not because of a lack of demand, but because of a lack of supply. That's the supply shortage hitting retail sales. You had gasoline station sales up 2.4%. That's probably most likely higher gas prices, but also people hitting the road a little bit. The question becomes that we don't know. I'll give you a couple other numbers here. Clothing down 2.6%, but of course that's been up 43% year on year. Non-store retailers also down, and merchandise stores down a little bit. But very strong retail sales up until this point. What we don't know is, was this data too early to pick up any impact of the Delta variant, whether or not the Delta variant is indeed going to show up in the retail sales numbers that we're looking for here. But this is a big miss, but we've had a lot of volatility that's been related essentially to when those stimulus checks come and when they run off. Andrew?
Shepard Smith here. Thanks for watching CNBC on YouTube.